And now I'd like to introduce President of Carter Investment Services, Mike Carter.
Good morning, everyone. Glad to have you on the webinar this morning. We're going to go over investing. We're going to talk about some basic things. There's a lot more to cover than what we're going to be able to get in this morning, but this will give you an idea of some of the places to get started when it comes to investing for your financial future. I am Mike Carter, Carter Investment Services. I'm a member of the Chamber and a proud member of the Ambassador Committee with the Chamber. First things first, I have to go through the legal stuff. The government requires me to make these legal, to let you know who I am and what my designations are and what licenses I've got. So everyone read that very quickly, memorize it, and we're going to move right along to the next slide. First things first, when it comes to investing, what the first thing you need to do is make sure that you're in a financial position to do so. Getting out of debt is hugely important. Not so much paying off your mortgage because of the low interest rate, but your credit card, if you have any other high interest rate debts, you want to get those taken care of first. Paying off a 20% credit card expense is actually a 20% rate of return on your money. You want to make sure that you've got an emergency fund. You don't want to have to tap into your retirement account if you suddenly, you can't afford to pay the rent. So you want to make sure that you've got anywhere from 3 to 6 months worth of an emergency fund set up. You want to consider what's important to you. What are you trying to accomplish with your money? You also want to make sure that you are protected in case your income stops for some reason. And then again, you want to figure out, well, what is my money going to be used for? What's my timeline? From there, what's the goals for your money? I mean, is it something short term? Hey, I want to make sure I've got some money to, buy a new car. I want to buy a home, so I got to put some money down. Is it something longer term? You want your kids to go to college. You want to build wealth long term. Would you like to become financially independent? And when you're figuring out your goals, you need to figure out, well, what does that mean to me? How much money will I need? Is it a lump sum? Do I need $1 million? Or am I going to need, $3,000 or $4,000 a month in retirement at age 65? From there, we move into figuring out what is your comfort level with where you're invested. How much risk are you comfortable with? If you have trouble sleeping at night because you're worried about your statement and you go online every day, you might want to pick some more conservative things to be involved with. If you've been investing for a while, what was your reaction when the market went down in the Great Recession? If you were somebody that saw it as an opportunity, then you can probably stand at more risk. If you were somebody that went, I have to get out, then you probably want to be more conservative going forward. One of the things that you can do to do this is actually sit down and work out a worksheet to figure out what your risk is. Well, let's talk about risk. The common things that folks think about is that the more risk you take, the better rate of return you'll get. And as you can see from this chart, the riskier an investment looks like, the higher expected return you want. Now, the thing is that when you do investing, you want to make sure that you're paying attention to the particular investments that you're in because they don't all work in a straight line like this. Sometimes you'll find things with a high risk that don't necessarily have a high rate of return. And then sometimes you can find things where the risk isn't all that bad, but your rate of return is actually pretty good. So it's a matter of getting educated and making sure that whoever, whether it's you or somebody that you're working with, is actually sitting down and figuring out what your comfort level is of risk return on an individual basis. Let's go back to before you're investing. It's not just about paying off your bills, but is your budget balanced? If you have more money going out than you have coming in every month, it will make it tough to invest. Are you currently saving every month? Well, if you are, that's a great thing. Again, the first thing that you want to build up is that emergency fund. Once you get it built up, though, a lot of times taking some of that savings that you've been putting into your emergency fund is a great way to invest. Do you pay your credit cards in full every month? Running a small balance on your credit cards is actually very good for your credit score, but you don't want to run a very high balance because it's expensive and bad for your credit score. If you'll talk to credit professionals, they'll tell you if you hold more than a 50% balance on your credit card every month, it's actually horrible for your credit score. One of the other things that you want to look at is making sure you've got insurance in case something bad happens. Whether it's life insurance if you have loved ones, disability insurance, do you have long-term care insurance in case you need to go into a nursing home? Do you have enough adequate automobile or liability insurance? So you want to make sure that you're protected in case the unforeseen happens. Well, let's go over potential risks. Now, one of the potential risks that you can have, what most folks think is that risk is only, hey, I'm going to lose all my money. But actually, one of the potential risks you can have is being too conservative. Most folks that have a checking or savings account now realize that there's very little rate of return in those. Even CDs at the bank haven't quite reached the 3% rate of return mark. Now, the advantage to being conservative is that your money's safe. You're not going to lose it. The disadvantages, though, is one, you're going to lose purchasing power because inflation happens whether you account for it or not. And it does average right around that 3% right there that's on the screen. And so if you're only getting a 1% rate of return on your money, but you're getting a 3% increase in costs on what you're buying, you're actually running backwards at 2%. The other thing about being too conservative is if you've got goals that you want to achieve, like I want to buy a beach house down the road, or hey, I want to send my kids to Harvard or Yale. Well, if you're not getting a decent rate of return, it makes it much tougher to reach your goals. Now, on the flip side, we've got being too aggressive. I run into this a lot because people are like, let's go, Mike, mom's eye. Sort of like going to live in Las Vegas, so we'll make a gambling analogy. It's like going into the casino, and gee, Mike, I'm playing roulette, but they get a much better payout if you only bet on one number. The reason they offer a much higher payout is because it's tougher to achieve that one number when you're sitting at the casino. By the same token, when it comes to investing, while it's not quite, the number's hopefully a little bit better for you than the odds at the casino, you still have to understand that while there's potential for growth, you still have to realize that you can lose money the more risk you take. There's market volatility, and that's one of the risks that you end up with. It's not just the company, it's the market. A good example of that is when cars first came out, the buggy whip, to whip the horses to go faster on buggies, was a great industry to be in. Once the car industry took hold, though, that market kind of went down. And so it was no longer a good industry to be in, no matter how strong the company making said buggy whips was. The other thing about being too aggressive is there's not always guarantees or insurance. You may run into a situation where, again, you're invested in buggy whips, or maybe you're invested in the internet back in 2000 when people were just speculating wildly. Well, it's a $200 million company, and all they really have is an internet address and a good idea. Well, a lot of those companies ended up going belly up, and that whole $2 million went away. So it can happen where you can lose a lot of money if you're too aggressive. And it wasn't just growth that people were losing, it was their principal that they'd invested in. This is funny, so I'm going to let everyone read it. And we're going to go next. So how do we manage the risks? Well, obviously we want to figure out what we're going to do with the money. If it's something short-term, an emergency fund, hey, because I need that now. And if something happens, I need to be able to access that. Or, I'm putting money down for a down payment and I want to have it in a year for a house. Then you want to be conservative. You don't want to get, crazy with your money. And, hey, I could lose half of the, money I put away for my emergency fund. For college, which is going to fall probably for most folks in between those two, you can be more aggressive. But, again, the closer your child becomes to college, then you want to take that and make it a more conservative account. And the same thing holds true with retirement. If you're young and you've got a lot of time before you can retire, you can afford to take the time and say, hey, I lost money this year, but that's okay because I'm not worried about it for another 20 or 30 years. It's an opportunity to buy, in fact, when the value of something goes down. As you get closer to retirement, you'll become more conservative. So what you want to do is you want to match your goals. being more conservative with short-term money, being more aggressive with long-term money, with your comfort level on doing that. So while you may have a long time before you're actually looking at having the money needed in your income, if you're not comfortable with putting it all at risk, you'll end up being less aggressive than somebody who is, and that's okay. So now here are the actual time frames I've mentioned: short, mid, long term. Why don't we just look at what they are? With short term, obviously what you want to do is make sure that really you're not horribly concerned about getting much more than a minimum rate of return. 10 years ago, you used to be able to get a 3 or 4% rate of return on short term, but the markets and the interest rate environment has changed, and now it's a lot lower. The midterm, again, is a lot closer to, if I've got a child that's 7 or 8 years old, that's 10 years until they go to college. You want to take some risk because you're looking for a better rate of return, and you want to make sure that you're beating inflation, but you obviously don't have as much time to make up a loss if it's a 10-year type of thing. And then, of course, long-term is generally what most people think about when they think about retirement. You can take more risk because you're looking to actually have the market go up and down in that period of time. And what you want to be able to do is take advantage of it in both directions, but you also have an opportunity to make money after a downturn. So that's why long-term is more than 10 years. So now, what were some of those short-term products? We have actually touched on a few. We call them cash equivalents, particularly if you're looking at having that emergency fund. Gee, I need to get out of, I need to be able to get this money out, in an emergency. They're generally low risk savings, CDs, cash. They're called liquid assets. And again, it's for folks who have got short-term needs or they're just not comfortable taking a lot of risk. So now we move on to more investing terminology. Stocks are ownership in a company. Bonds are money that's loaned to an issuer, or you take out a loan as a company. The easiest way to think about this is that stock is like owning your home. The bond is like the bank's loan mortgage on your home, except both of these are on companies. The advantage to stocks is the unlimited growth. Facebook doubles in value, I just doubled my ownership. If I own stock in Facebook, I just doubled my value. If Facebook has taken out a loan, the lender doesn't get double the interest rate simply because Facebook's value went up. They get the interest rate that they agreed to. On the flip side, if Facebook goes bankrupt, the stock can become worthless, whereas the bondholders are basically among the first people paid when they start liquidating things. Lots of people go, well, that's great, Mike, but I have a mutual fund, so I don't have stocks and bonds. Actually, what a mutual fund is somebody managing a diversified portfolio of stocks and bonds, and there's actually a lot more things that can be inside of a mutual fund. Besides that, there's real estate and a ton of different things. Really, what a mutual fund does is it allows you to have more baskets, particularly if you have more than one mutual fund, that hold eggs. And what the mutual fund enables you to do is it enables you to have more than eggs in more than one basket, all your eggs in more than one basket. This is a common misconception with retirement planning. The funny thing is that what 401k is just 401k of the IRS code. But it's now become the name of what people assume is retirement planning. So let's talk about retirement planning. Now, what the 401k does is the federal government is giving you the opportunity to put money away without having to pay taxes on the money when you put it in. It comes out of your paycheck pre-tax, so that's a good thing. It grows without being taxed, which is what tax deferred means. Your employers can match, and the advantage to the employers is that one, it's good for the employee morale. It's good for the employer because they generally also invest in this, and the employer also sees some tax advantages with the match. What you need to do is balance what you need to invest is. Well, what are my goals down the road with just getting the match? This is a general term, but I generally always talk to people that if they've got a match at work, take it. An IRA is an individual retirement account. Now, this is something where you invest on your own without going through your employer. It also grows tax deferred. Once the money is in a 401k or an IRA, they're essentially the same type of account. The difference between those two accounts is how the money gets in there. You also have, and we'll go through IRAs, we have what's called the Roth IRA, and Roth is simply one of the senators that sponsored the bill that allowed the Roth IRA. It's different than a traditional IRA. You pay your taxes up front. What the difference is that with both the traditional and the Roth IRA, you don't pay taxes as it grows. Because you paid the taxes up front with the Roth IRA, when you take the money out of the Roth IRA, it's tax-free. One of the advantages to that is you then know what your taxes are going to be because you paid them up front. So you already have the taxes figured out. With a traditional IRA, you get an upfront tax deduction. So let's say that you've got, it's April 12th, and you're like, wow, I've got all these taxes due to the IRS. Well, look, I can take $5,500, contribute it to a traditional IRA, and get a tax write-off on that $5,500. One of the disadvantages, though, to the traditional IRA is you don't know what your taxes are going to be because you pay them at withdrawal, and we don't know what taxes are going to be in the future. I don't even like to try and figure out what Congress is doing next month, so what Congress may do 30 years from now is a little tougher. Retirement accounts are not an investment. Think of a retirement account as an umbrella over your investments. It's a tax umbrella. Some investments actually come with their own tax umbrella. Some don't. Regardless, a 401k or an IRA or a SEP or a simple IRA or a 403b or a 457 plan, which are just different names for different retirement accounts, are just simply very cool retirement umbrellas to help keep the government out of your pocket. And again, where you put that money is up to you, although there's some restrictions with retirement accounts about where the government will let you put your money. So part of the criteria, and this is not the only criteria, there is more, is you actually have to have earned income. Now, if you're married, one of the spouses has to have earned income. Both of them do not. And so, if you have two spouses, one of them has earned income, that $5,500 annual limit that you see is actually $11,000 for two spouses. That is indexed for inflation. It was $5,000. Now it goes up in $500 increments whenever they determine that the index will cause it to go up. There's no particular set way that that's done. They let us know about 6 months in advance. You can contribute less than the limit, less than the $5,500, or any of the other limits for retirement plans. If you are 50 and older, there's actually a $1,000 a year catch-up that applies to retirement plans, and in the case of an IRA, it means you can put away $6,500 a year. You can invest in a 401k up to the full match, and that would be what I would absolutely recommend most of my clients do, because if your employer is putting money in, that's free money. We don't want to miss out on that 100% rate of return, free money. Some of the possible downsides to a 401k is that you're restricted to what the plan offers. Most of the time, the employer picks a few funds. It may not be the ones that you're looking for, although most plans that I sit with and look at have got a nice variety of funds to work with. Another disadvantage to 401ks is they may charge higher fees than you would get with an IRA or a Roth IRA, so you want to make sure that you're taking an objective look at that as well. If your employer is not matching at all, well, then an IRA might work just as well for you. And again, you want to use a traditional IRA if your employer doesn't match, or if you've already invested up to your match. The advantage to the IRA is that, it's your own plan, so you get to control it. The other thing about traditional IRA is a lot of folks want that tax breakdown, and that's a benefit if you actually expect to be in a lower tax bracket at retirement. Now, if you think that taxes are going to go up, or if you just are like, look, Mike, I want to have more income in retirement than I've got now, then maybe what you want to do is invest in a Roth or use a Roth IRA to protect your investments. Because what that will allow you to do is pay your taxes now, but never have to pay them again on that money. The other thing that having a Roth IRA could do, particularly if you already have a 401k, is it offers tax diversification. Most of the time when we talk about diversification, it's investment diversification, eggs in more than one basket. But you can actually do it with taxes. So now, when you're talking about a long-term strategy, and it's bolded, so I'll say it, buy and hold, anticipate long-term economic growth. So, in other words, if you think that the market is going to continue to do, and then when we talk about the stock market, it's the Dow Jones Industrial Average, it's the S&P 500. If you think it's going to continue to do what it's done, and you're okay with the fact that it's not going to do it in a straight line, but it'll go up and down, then you want to buy and hold. Now, you don't want to always hold things that, a buggy whip company maybe would not have been the greatest place to hold. But Ford or Dodge back in the day might have been great places to buy, and then they had their ups and downs. But if you held, you've done quite well. Now, as I said previously, past returns are no guarantee what's going to happen in the future. One of the things you can help do to mitigate that is what's called dollar cost averaging. And essentially what you're doing is every month you have $100 taken out of your paycheck for your 401k. Well, when the market's up, you'll buy less. When the market's down, you'll buy more. Kind of like the way you shop at a grocery store. One of the biggest things that you have to avoid, and it talks about it right there, jumping in when the market is high and pulling out when it drops, is trying to time the market. People do it constantly, and it's an unsuccessful strategy almost 100% of the time. The easiest way to do the dollar cost averaging is to do that automatic deposit, and dollar cost averaging avoids trying to time the market. Well, we talked about tax diversification and portfolio diversification. Essentially what it does is it reduces your volatility. Money is like manure. If you leave it in one spot, it stinks. But if you spread it around, you can grow some stuff. Basically what that means is that, again, it's eggs in more than one basket. Some investments will go up while others go down. You want to make sure that you're actually spread around so that you don't have everything, invested in one spot, and if it goes bad, it goes bad. We talked about market timing before. 1.8% is what determines what your portfolio is going to do. The key, some of it's where you're invested, but really it's just spreading your risk around. So how do we make this all easy for you? You can set it up on a payroll deduction, which is your 401k. You can actually set it up to debit out of your checking account if you're going to do an individual account, whether it's an IRA or a non-IRA mutual fund or any other investment. So some of the advantages to mutual funds, basically, is buying stocks and bonds, but having somebody manage it for you. Because you're not buying one stock or one bond, you've got diversification. And it's something you can look up on the internet. Monitoring it is simple. Mutual funds are actually on most of the financial websites. Mutual funds do charge fees. Shouldn't always worry about the fees. Some of the best performing mutual funds charge high fees. Well, if I'm going to get a 20% rate of return and pay 3%, that's better than a 7% rate of return where I'm paying 0.5%. But pay attention to those. And then, of course, with being aware there's no guaranteed rate of return for mutual funds. Educate yourself. The most important thing that you can do is knowing what you're going to do. Sticking to your plan is probably another super important thing. Know who you're working with so you can avoid getting taken advantage of. So we want to know about expenses, but you want to balance that with, well, what kind of rate of return are we getting? Because, again, expenses aren't the key. It's what my net rate of return is. Sometimes low expenses help that. Sometimes it's just what kind of rate of return are we getting? What's my goal? And then we want to keep Uncle Sam out of our pocket as much as possible, so we always have to think about taxes. So if you're like, Mike, this is great, but I don't want to work that hard doing it. Well, the cool thing is that there's actually ways, a lot of 401ks have got this, and you can even do this outside of a 401k, where you can buy a mutual fund that adjusts as you get older. So it may be aggressive in the beginning and conservative at the end, but you stayed in the same mutual fund. They'll do the rebalancing for you. They'll do the averaging for you. You've got things like index funds, products that base themselves on what the S&P 500 is doing. And the S&P 500 is 500 of the largest companies and about 75% of the U.S. economy. And again, automatic deposits, you also want to make sure you're doing a checkup every year. Never, ever invest in something that you don't understand. That's probably the most important thing that you can do, is making sure that you understand where you're at. And the other thing I would recommend is that either educate yourself or work with a professional that knows what they're doing. That is the end of our presentation. Please feel free to ask any questions that you folks might have.
Just remember, if you'd like to ask a question, you can type it into the chat box on the bottom left corner of the screen, or you can press *7 on your phone to unmute your line. Just a quick reminder that you can catch all of the Chamber University webinars on lvchamber.com behind the members only portal. We do have a question. What is the first thing I do after Chapter 7 discharge?
After you've been through a bankruptcy, which is what Chapter 7 discharge is start from the beginning, rebuild your emergency fund. It's actually easy to get a credit card once you've been in bankruptcy because you can't do a bankruptcy again for 7 years. So getting a credit card with a low minimum on it to reestablish your credit is an important thing. These are where I would start, making sure that, if you're renting, you want to make sure that you get the ability to get a better rate of return. There are both secured and unsecured credit cards available. There's nothing wrong with a secured credit card. It also builds your credit score just the way an unsecured does. So it depends on what you're eligible for, but there's companies that will do both. Are there any other questions?
Well, seeing none, I want to thank you so much, Mike and Carter Investment Services, for joining us today for Chamber University this week. I hope you guys found this presentation helpful, informative, and I want to remind you that next week, May 6th, I think, we will be having Jason LeDuc of Evil Genius Leadership Consultants. He's a new member. He's going to be talking a little bit about how to have a competitive edge in business. So make sure that you tune into that one next week, and thank you all so much for joining us today.